Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I'm sure you've heard of Socrates, the great Greek philosopher, and arguably one of the greatest philosophers of all times. Now, Socrates had this very important habit, or quirk, if you will. He used to stop random people on the streets, in the marketplace, at the playground. He used to stop these random people and he used to ask some deep, profound questions to them. Questions like, what do you think is courage? What do you think is virtue? What do you think is honesty? What is meant by truth, the absolute truth? And these are very tricky questions to answer, and these are very deep and profound questions. Socrates was of the view that an unexamined life is not worth living, and therefore human beings should always try and ask these deep questions to themselves, and they should self reflect, and they should and analyze so that they can improve the quality of their lives and of their fellow human beings. And I think this is a fantastic way of looking at things, or thinking through some really profound stuff in life. Now, if Socrates were alive today, and if he were to go around town asking people, what do you mean by investing? And I'm sure he would have gotten a bunch of different answers, a bunch of very interesting answers. But as far as I'm concerned, I would have replied him something like this. Investing is trying to arrive at the intrinsic value of a company and then buying the stock if the price of the company, the stock price of the company, is trading at a significant discount to intrinsic value. That, according to me, what investing is all about. And while this definition sounds very good in theory, there are a couple of very big practical difficulties you run into when you try to implement this, this definition of investing or this theory in practice. One big problem is intrinsic value is a moving target. We are living in times, or we've always lived in times, where product life cycles change, people's preferences change, policies, government policies change, technologies change, and therefore the intrinsic value of a company that's dependable, or that can be relied upon in one time period, can become extremely useless, or become worthless and become non-dependable in another time period. So that's one risk of trying to arrive at the intrinsic value, that it's forever a moving target. The second big risk is depending on the underlying company, depending on the quality of the underlying company, the dependability or the reliability of intrinsic value differs. So while it may be quite reliable in one case, one company, it could mean something entirely different or highly unreliable for another company. Now, in order to further understand this, let us try and take one case study as an example, so that you understand this whole concept around intrinsic value better. So what you see on your screen right now are two companies, company A and B, and if you look at company A, it is quite clear that it has a remarkably stable earnings profile. The EPS of the company has not only grown, but it has grown at a very consistent rate. And if you arrive at the average EPS of the company over the last 3 years, it's rupees 7.1 per share. It has a debt to equity ratio of 0, debt free balance sheet, which is very good, and an ROE which is reasonably good, which is quite good actually, in the region of 18 to 20%. So if I were to arrive at the intrinsic value of the company, I know that provided the future of the company is quite similar to its past, there are no big surprises in the future, and the past can be relied upon as a decent guide for the future, the intrinsic value of the company would be the average EPS of the company multiplied by a multiple of 16, 17 times. Given the balance sheet strength of the company and the average ROE, I think a 16, 17 multiple would be a decent multiple to give to the company. So if you multiply 16 by 7, you get somewhere around 112, 120 rupees as the intrinsic value of the company. And you should always buy a company at a discount to its intrinsic value. So let's say a 30-40% discount to 120 rupees, will give you entry price of around 65 to 70 rupees per share. So if the stock is trading at a discount of more than 30-40% to the intrinsic value and is trading at around less than 65 rupees for this company, then it's a worthwhile investment. Now let me tell you which company is this. This company is Bharat Electronics. It's one of India's largest aerospace and defense companies, and it was in fact trading at around 58-59 rupees per share about a year back, which means that it was trading at a discount to its intrinsic value. And if you would have invested in the company back then, you would have doubled your money. The company right now is trading at around 118-120 rupees per share. And if you would have invested, you would have doubled your money, which of course means that the intrinsic value of the company proved to be a pretty reliable indicator for this particular company. And if you would have invested at a discount to that, you would have made good money. Coming on to company B, its earnings profile is all over the place. For the first few years, the earnings have grown, then they have declined. 2016 onwards, the company has even incurred a big loss in the year 2020. Its balance sheet is loaded with debt, and the average ROE is worse than even what fixed deposits could give you. So if you ask me, an intrinsic value, trying to arrive at the intrinsic value of the company is an exercise in futility as far as company B is concerned, because there is the reliability of the intrinsic value is going to be pretty low, because I have no idea what the EPS of the company, average EPS, what the EPS of the company would look like if the past is identical to the future. Now, this does not mean that the intrinsic value of company B is zero. The intrinsic value of, let me tell you which company is this. This company is one of India's largest telecom operators. It's a blue chip, it's Bharti Airtel. And of course, this company is not trading at zero in the stock market. It's trading at around 540, 550 rupees per share. So the investors or the market is assuming the company to be worth 530-540 rupees per share. But why is this the case? I think the reason this is the case is because investors are expecting the company to have a much brighter future than what the past suggests. Investors are assuming that good days lie ahead for the company, given how the sector scenario has changed, how the competitive landscape has changed, and because the company is going to make a break from the past, its future is going to be much brighter than its past. It deserves an intrinsic value of 530-540 rupees per share. Now, is this justified? If you ask me, my personal preference would be to not have a look at the company unless the improvement starts reflecting in the finances of the company. I'll wait for 2-3 years to actually see the EPS improve to respectable levels, to see the EPS go up to 30-40 rupees per share before making a commitment in the company. Unless that happens, it's all speculation. A lot of analysts out there believe that the company's future is definitely better. The business model of the company is changing for good. It's on the path to recovery, and therefore the company deserves a price of 530-540 rupees per share, or maybe even higher. Now, if you want to invest in the company, you will not have to listen to these analysts, but you will have to do your own research or rely on someone's judgment who you trust. You will have to do your own analysis of the company. You'll have to do your own research on the industry, on the stock, and try and figure out whether this is indeed the case, whether the future of the company is definitely better than the past. And if you feel that the company would have an EPS of 30, 40, 50 rupees per share going forward, you apply a certain multiple to it and they arrive at the intrinsic value of the company. But as far as I'm concerned, as I said earlier, I need for the improvement to start reflecting in the financials before I make a commitment or make an investment in the company. And I think this is the number one mistake that people make when it comes to investing in stocks. They will ignore a very simple company like Bharat Electronics, which is lying in plain sight, and which has a very good earnings power, and for which the intrinsic value is highly dependable. They'll ignore all that and they'll try to invest in a complex business model like Bharti Airtel, which has had all those struggles in the past, and where it is difficult to figure out the true intrinsic value of the company. They'll try and do something which is cannot be done to a reliable extent, or which cannot be done quite reliably. And this is the mistake that quite a lot of investors they make. You have to understand that investing is not Olympics where you have extra marks for complexity. It's not gymnastics where you perform difficult stunts and you get higher marks, or it's not high jump where higher jump the more points you get. There are no extra marks for complexity in investing. In something like investing, simple always works better than complex. You have to keep it simple. When trying to arrive at the intrinsic value of the company, you have to look at business models which are simple to understand, and where the future is going to be identical like the past. The future will not throw up a nasty surprise, and you should try and value those companies and invest in them, because that's a better way of making good long-term money from the stock market, rather than try and analyze a complex business model like Bharti Airtel. I'm not saying it's impossible to do so, but it's very difficult. And when you can make returns the easy way, why choose the complex way? Why try and analyze a complex business model like Bharti Airtel, where you can find lots of companies which have a similar profile to Bharat Electronics, and which can be analyzed, and where intrinsic values can be arrived at in a much more reliable way. So when it comes to choosing between the simple and the complex, always try and choose the simple and ignore the complex, and I think you will do well in the stock market over the long term. So that's all from my side today. Let me know what you think of this video. Do send in your comments, likes, dislikes, so that we'll know how to serve you better in the videos to come. So take care. I'll see you around. Thank you so much.